Hi everybody, Alex Ploy here from Expert Forex. I hope you enjoyed today's Forex trading video. I've always said that the market tells you exactly how it wants to be traded. All you need to know is the language of the market. So in this lecture, we're going to be looking at some advanced aspects of channel trading. And I'm going to do my best to translate the language of the market to you. We're going to be looking at the channel trading using different perspectives. And I'm not going to go into some of the techniques that I'll be mentioning in detail. Those are covered in other courses and other videos. But it's important to understand that channel trading actually covers a lot of other techniques. Channel trading can stand on its own 3 feet. And why I say 3 feet, you need 3 points to draw a channel. So let's go straight into the chart that's on your screen right now, and let's see what information we can gain from it and what translation I can apply to this particular chart. So we had a channel that developed over time, and 1 was over here, 2 was over there, and 3 was over there. So that's why I say we need 3 turning points to create a channel. After we've had number 3, number 4 becomes a predictable bouncing point. Number 5 becomes a predictable bouncing point in terms of channel trading. And then 6 becomes a predictable bouncing point. But as you can see, the price never reached 6. So what happened was the price action turned into a failed swing. And we all know that when there's a failed swing, the chance of a breakout is quite big, and that in fact happened. And when a breakout happens, it tends to run more or less the width of the channel. A lot of what you've seen before happening on this particular chart. But let's start looking at it from a few different perspectives. And one of the perspectives that I like doing when I'm trading is I like looking at my channel trading perspective using other trading techniques and also the order perspective in the market. All right, so the first thing I want to point out here is that we're actually looking to trade spikes, and not when the spike has been confirmed, when it's at the extreme point of the spike. So for instance, if you look at number 2, there's a nice spike there. We want to trade that spike where it occurs. Obviously we can't do that because the channel hasn't formed at number 2 yet. So when you look at number 4, if you look at that channel, that candle formation, it is in fact what we call a railway track candle formation. So if you add the 2 railway track candles together, you get a spike. So that was in fact a spike right there. Then you come down here and you look at number 5, and there you've got an extreme railway track formation, and again add them together and you get a huge spike. So why are we interested in spikes? Spikes are where the market has moved quite strongly in one direction, and a big order from a big player has said, I don't like what's going on here, get back where you once belong. And that order is not only strong enough to stop the momentum of the price going up, but it also pushes the momentum down. It's a huge signal in the market, and one that is really good to trade because it moves very quickly in your desired direction. Also, if you spot them well, you don't need a big stop. So let's have a look at ways of spotting these areas quite well. So on the screen you'll also see a number of horizontal support and resistance lines. Those are historic horizontal support and resistance lines, some coming from daily charts, some coming from the same chart we're looking at now, and I'm not going to go into detail about those, but you must be aware that some traders are support and resistance traders, and they trade in a specific way. They will mostly trade bounces on support and resistance unless the price action tells them otherwise, and we'll go into that in a little bit more detail. So let's look at the move from 4 to 5. 1, 2, 3, and we had a predictable bounce at 4. So the move from 4 to 5 was a tradable move. So let's say we put our sell in there and the move came down to 5, which it just touched. Now let's talk about that area where that huge spike occurred, and let's look at it from different perspectives. Firstly, from a channel trader's point of view, you would be putting a buy order at 0.5. Why? Because you want to buy the bounce to number 6. That's the one reason. But if you were in a trade from number 4 to 5, that is when you would expect the run to stop, when it hits the next channel line. So you would also be putting a buy order to get out of your sell order. So at number 4 you sell, you cancel it out with a buy order to cancel your trade out. So firstly, from a channel point of view, there's a few buy orders sitting around at number 5. So now let's look at it from a support and resistance point of view. This is quite a major support and resistance level. The support and resistance traders will say, okay, the price has run quite a bit, and I'm going to put a buy order here for a bounce. So the support and resistance traders will be putting in buy orders right there. So let's look at it from a Fibonacci point of view. And I haven't drawn the Fibonacci lines, and the reason why I did this is I don't want to clutter the chart. But number 5 is also at a 61 or 38, depending on what way you trade Fibonacci level. And interestingly enough, number 3 is also a Fibonacci level. So those are the points where Fibonacci traders are expecting bounces. So now we've got channel traders expecting bounces, we've got support and resistance traders expecting bounces, and we have Fibonacci traders expecting bounces. So what happens? So as the price comes down to number 5, there are a huge amount of buy orders just sitting there waiting for the price to reach that level. So what happens when the price reaches it? It gets a massive shock, because suddenly there's a rush of buy orders into the market, and what happens? The price just shoots up because there's a huge demand for the currency. When you buy, you're creating demand. So there's a huge demand, and look what happened. It just shot up, and in fact this was a double in a day trade because it shot up with such volatility. It went well over 100 pips. So you've got to look at the market from an order perspective. Where are the major orders placed? The major orders in the market are placed at the edges of channel trading, or at the edges of support and resistance trading, or Fibonacci levels. So all you have to do is understand the language of the market. You say, Mr. Trader, I've got lots of buy orders in this area, and then you trade accordingly. There's one translation. Okay, so let's have a look at the next transaction that happened. The channel trade made a failed swing and then moved down to the bottom channel level. Now we all know when the failed swing occurs, there is a likelihood of a breakout. So again, and the fact that there was a minor channel which was channeling down, which also gave us an idea that there might be a sell breakout. But essentially, you have another support and resistance level at that particular level. You've got your channel pushing down on a sell. It's the sellers are preferred direction because this is a failed swing. And what would happen is the straddle traders would put a buy order above that consolidation and a sell order below that consolidation. The channel traders would put a sell order below the breakout point. The support and resistance traders will put sell orders just below that breakout point. So what happens? The price breaks out, it encounters these huge amount of sell orders, and boom, it just shoots off volatility, and that's what we're looking for. We've got a course called long candle trading, and this is exactly what we're looking for. We're looking for the long candle because it moves very quickly in your desired direction, and this is what happened. Boom, down it went. So you need to start looking at the market from a order perspective, and channel trading really makes that a lot easier, and that's why I've included this particular aspect in this course. To a certain degree, this also explains the problem that people have. Is it going to bounce or is it going to break out? If you analyze it from a multi-trading perspective and from an order perspective, you'll have a better chance of making those judgments. Another thing that you need to look at when trading, and what channel trading really helps with, is don't trade in the middle of a channel. The middle of the channel represents the area of the most indecision in the market. So if you look again at this particular channel, you can see the middle of the channel over here, where my cursor shows the indecision. The middle over here, lots of indecision, long spiky candles, lots of things. It's at the edges of the channels that decisions are made, and that's why you have the spikes, the big moves in the market. So if you want to trade in a risky way, trade in the middle of a channel. If you want to trade in a more decisive way, trade at the edges of channels. So just to repeat, channel trading is the basis of double intraday trading because it produces long candles. It also helps you find the decision points in the markets, the places where the market will move in your direction very, very quickly. It is good to look at the market from different perspectives. Think like a support and resistance trader, like a Fibonacci trader, from a straddle trader, a trend line trader. Think from that perspective and think where they would put their orders. And that reminds me, you don't only have to look at where they put their entry orders, you also need to think about where would they put their exit orders. I hope this lecture helps you understand some of the dynamics that exist in the market, and also I hope I've helped you translate how the market is always telling you how it wants to be traded. All you have to do is have a quiet mind and listen to the market. Don't force your ego onto the market. The market will let you trade it the way it wants you to trade it. So let's move on to the next lecture.
Thanks for watching this video. You can find links and more information about the video in the description. If you found it interesting, please like it and share it with your friends. Also remember to subscribe to our channel so that you don't miss any future Forex trading videos. So from me, Alex Deploy, cheerio.